Commodities are physical goods that are traded in organized markets and serve as essential inputs for global economic activity. They are generally categorized into energy commodities, metals, and agricultural products. Energy commodities include crude oil, natural gas, and gasoline, while metals include gold, silver, copper, and aluminum. Agricultural commodities include wheat, corn, soybeans, coffee, and livestock products. Commodity markets are important because they facilitate price discovery, risk transfer, and resource allocation across the global economy. Unlike financial assets, commodities often involve physical storage, transportation, and seasonal production factors. The program emphasizes commodity fundamentals because commodity price volatility significantly affects corporations, investors, financial institutions, and economic stability worldwide. Commodity prices are influenced by a wide range of supply and demand factors. Supply conditions may be affected by weather patterns, geopolitical conflicts, mining output, technological developments, and government policies. Demand is driven by industrial production, economic growth, population trends, and consumer consumption patterns. Commodity markets can experience significant volatility because supply adjustments are often slow, while demand conditions may change rapidly. Seasonal patterns are particularly important in agricultural commodities, where planting and harvesting cycles influence availability and pricing. Energy markets are also highly sensitive to geopolitical events and production decisions by major exporting countries. Understanding these market fundamentals is essential for evaluating commodity price behavior and associated financial risks. Commodity derivatives, particularly forwards and futures contracts, are widely used for hedging and speculative purposes. Producers use futures contracts to lock in selling prices and reduce revenue uncertainty, while consumers hedge against rising input costs. Airlines, for example, often hedge fuel prices using energy futures contracts. Speculators participate in commodity markets to profit from anticipated price changes, providing liquidity to other market participants. Commodity exchanges standardize contract specifications, including quantity, quality, delivery location, and expiration dates, enhancing market efficiency and transparency. Because commodities are subject to unpredictable environmental and geopolitical influences, commodity futures markets play a vital role in transferring and managing price risk throughout the global economy. The pricing of commodity forwards and futures differs from financial asset pricing because commodities involve storage costs, insurance expenses, transportation costs, and convenience yields. The cost of carry model remains the foundation for pricing commodity forwards. Under this framework, the futures price equals the spot price adjusted for carrying costs over the life of the contract. Carrying costs may include financing expenses and storage fees associated with holding the physical commodity. However, unlike many financial assets, commodities may provide a convenience yield, which represents the non-monetary benefit of physically possessing the commodity, particularly during periods of supply shortages or production uncertainty. These unique characteristics strongly influence commodity pricing relationships. Commodity markets may exhibit either contango or backwardation depending on the relationship between spot and futures prices. Contango occurs when futures prices exceed spot prices, usually because storage and financing costs outweigh convenience yield benefits. Backwardation occurs when spot prices exceed futures prices, often reflecting strong immediate demand or limited current supply. Convenience yield plays a particularly important role during backwardation because market participants may value immediate physical access to the commodity more highly than future delivery. Inventory levels also influence pricing structures, as low inventories tend to increase convenience yields and contribute to backwardation. These pricing dynamics are important for understanding commodity trading strategies and risk management decisions. The program highlights commodity markets as an important area of financial risk management because commodity price fluctuations affect inflation, corporate profitability, investment portfolios, and macroeconomic stability. Commodity derivatives enable producers, consumers, and financial institutions to manage exposure to volatile raw material prices efficiently. At the same time, commodity markets present unique challenges due to physical delivery considerations, seasonality, geopolitical risks, and supply disruptions. Understanding commodity fundamentals, forward pricing mechanisms, convenience yield, and market structures such as contango and backwardation is therefore essential for risk professionals. As global demand for energy, metals, and agricultural products continues to evolve, commodity risk management remains a critical component of modern financial markets and economic analysis.